probably made if you've not paid for it, right? Services benefit. So profit and loss would typically contain the non-cash elements, and that will give you like a non-cash profit. But as you said, the most important thing is weekly inflows and outflows into an account, because at the end of the day, that's what you can plan with, that's what you can do life with, right? And do business with, right?
Yeah, and we're in danger of oversimplifying it, but there's also nuance in the inflow, right? Who's paying the inflow, right? If I know, ITA usually my invoice says 30 days, but ITA always pays me in 60 days, right? There's also some nuance in the inflow, right? It's not just simply just what's in the invoice, right? So, but yeah, simply put, that's it. That's it.
Okay, so if I summarize that, every business owner should have a clear idea of, say, how much we expect coming, how much we would typically spend, which is where budgeting and all that will come in. But we don't want to go into budgeting today. We just want people to understand why they could be making so much money, 3.2 billion every month, and can't afford to walk into, a dealership and buy a car. That's sort of like, where we want to keep eye on. And there's a very important part to this where you mentioned invoice and when payment is made, right? And that sort of moves us into understanding your cash cycle as a business. And I say that because typically business owners think about cash cycle be month to the end of the month, right? But I've seen certain businesses, oil and gas businesses, as you mentioned, that bought in contracts, they probably look their finance, say half month, right? And sort of have it cut off into the month sometimes. Or some people do weekly cash cycles, just to help them, realistically deal with, the big pictures of the business. So maybe one business is high expense, week 2 is always, maybe lower expense, and then the money comes 3, for example. And if you're not able to plan the expenses around, the specific weeks that you expect money to come in, you can also be in trouble. So it's not a month-on-month or first thing. So when we're thinking about cash conversion, right? What are like the things that you would typically, business owners to look out for, just to make sure that they're not promises to pay in week and then money probably drop, after week 3, stuff like that. What would be, your take on it?
Yeah, so I think the cash conversion cycle is one of the oldest, like credit account, right? And I think underneath you can pull to manage cash flow, right? So the cash conversion business can we use as an example. Maybe you buy goods from Temu and you resell, right? And then Temu gives you credit terms. Like Temu, you don't have to pay cash, right? Maybe you can pay in 30 to 60 days, right? You have what? So the trade payable has been created because now you need these goods, right? And when the goods of Temu arrive, they become in, right? You sell the thing, right? And sometimes you set for cash, so that gives me, or if it's like usually big business, which is not B2C, which is most startup and scaling business to be, right? Then you have to say to the people by like, oh, you don't have to pay me cash immediately because these are businesses, right? You can just pay cash every day, right? So you do like a pay you in a month, right? When our finance team goes through all the invoices and then they make the payments, right? So basically, so it's almost like a cycle, right? It's a sale, but it creates someone who you need to pay. You can negotiate whether you pay them a shorter time or a longer time, right? That'll also depend on how big you are, how much negotiating power you have, the bigger, like an MTN will probably have a 60 days. They'll pay you in 60 days, right? But the smaller businesses, people like, nah, pay us on receipt. So then when you make the sale, now you also need to negotiate with the people buying your stuff, right? Can they pay you in a shorter time? Or if you don't have a lot of negotiating power, they'll tell you we'll pay you in a longer time, right? So from a technical accounting standpoint, your policy on how long do you take to pay the people that supply you, and how long do you give your customers to pay you back, because has a heavy influence on your ability to have money in the business, right? And the stronger your company is, the more you'd want your customers to pay you quicker. You want your suppliers to pay your suppliers later, right? And this is very simplified, but like it becomes a lot more complex the more complex your business gets, right? And that's why I'm very keen to also hear some of the questions from people in the audience based on their actual types of businesses, so that we can really apply some of these concepts.
Okay, so you went the long route with really explaining what it is, and I mean I kind of like how detailed that was, because it gives a good picture of your cycle being the difference between when you receive and when your money will be due to the supplier called Temo, right? So that is like a very simple way to look at it, where how long does it take for me to pull in money, right? And versus how long it takes for me to meet my liabilities. The net of that gives an idea of your conversion cycle. Some people have a faster cycle. Big businesses actually have these advantages where, because of their bargaining power, they can go shorter with payments when they receive payments, but negotiate longer. Some of them do 60 plus. Some do. Government is typically between 30 and 60, but sometimes I said 60 plus can become 360 plus times 2 or something. So that's the downsides of doing business with the government. One other, I think, very interesting question that sort of simplifies this also for me is a situation where, say, a bookkeeping team or an accounting team sends in, let's say I'm a founder or CEO, sends in my profit and loss every quarter, and it looks really healthy, right? It looks like I should be doing good numbers. It looks like everything. I'm running a good business. Basically, I can beat my chest and say, hey, I have a good business, right? Just based on what that profit and loss looks like. What are the top 3 reasons or 5, just to you, that I would look really healthy on paper, my profit looking really good, but my bank account is screaming red, literally just on CPR, just on survival mode? What would be the top 3 to 5 reasons? I mean, just based on your experience, that things like this would typically occur.
Yeah, geez, that's a good question, Anita. I think I'll firstly say, I think each different industries will have different indicators, right? But I think broadly in general, I would say if I look at your accounting and I see that in your balance sheet you have a large amount of payables, right? Like these guys, the engineering guys that I was telling you about, if you look at their balance sheet, I think they have a big, customers owe them such a lot of money, right? That's always a risk, because the next question I'll ask you is, how much do you trust that you actually get all that money, right? Invoicing does not mean someone's going to pay you, right? And the bigger the receivable I see in your financials, the more I think, is it an issue with the team that collects these invoices, or is just the type of customer someone who struggles to pay you? So now it's just accumulating in your books as we'll receive money in the future, but that money is never going to come, right? So the quality of the receivable is also important, right? I think as a finance team, you also need to evaluate that quality, right? Which invoices are 30 days, which ones are 60, which ones are more than 120 days, right? And if there are more than 120 days, you start thinking, maybe we should write them off into the profit and loss as a write-off because it's not coming, right? Then the second thing is going to be an indicator is finance costs, right? Highly leveraged businesses are going to have cash flow issues, right? Because it means you are paying back debts, right? Let's say typical of a lot of Nigerian startups. I know our audience is diverse, right? But like in Nigeria as an example, right? You're in VC and your revenues are in Naira, and then you took a dollar loan, right? So yeah, you have this loan that is actually increasing, not just in finance cost, but also it's increasing by exchange devaluation, right? I know that the Naira has been stable the year past year, so maybe not as true now. But yeah, high debt can cause cash flow issues for sure. So I think those two things: receivables are high, potentially an issue. A lot of debt, potentially an issue as well.
Okay. Interesting. And I mean, if I were to maybe chip in one or two from my own end, just based on experience, is also commitments, right? Maybe heavy asset financing. So a business can be doing pretty well in terms of their operations, so buying and selling and all that. But they're taking that cash and tying into maybe assets. It could be buying, say, property, or you're developing like a property for the business. It could also be huge drawings from the founder, right? Because the drawings typically go to the won't show on the profit and loss, right? So drawings where the business owner is taking money from the business, right? Financing also from a maybe even equity perspective, where you're paying dividend and all that stuff, could also be thing and become a big problem for you. And then last, I think the biggest one that I also seen that is like, in fact, there's a client that we with that like right now is huge inventory, right? So for the business, because of how it's set up, they need to hold a lot of stock. Sometimes things go out of fashion and then comes back later on, so there's always hope that if I don't sell this thing today, the fashion is going to come back and I'm going to sell it, right? So you have a business that's generating revenue, let's say hypothetically maybe 200 monthly, right? But then their inventory that they are holding on is increasing by even higher than that, almost higher, or half of that amount is like inventory, and inventory is in billions, right? So, and you have to keep restocking because new trends are coming in, so you can't stop purchasing. So I've seen that this is like usually a problem for a lot of businesses. I've seen this in tiling business also, not just fashion, tiles, people that stock tiles and bathroom accessories and stuff like that. They seem to have a similar problem. You have an entire warehouse of stuff that you're just waiting for it to get back into fashion. People are now buying this one now, you have to stock it up, and then hopefully the other one comes through. So that can be a very, very big problem with just having good business versus now cash flow from a management perspective, right? So I just wanted to chip in that just from my own personal experience, some of the issues that we had, yeah. And then for service firms, I think service business is like the trickiest business as far as I'm concerned, if you're an entrepreneur. And it is very tricky because you're expected to act professionally. So even when people owe you cash, you can't do certain things to recover cash. So if you're here and you're running a service business, my heart goes out to you. I know it's one of the toughest businesses, especially if you're a professional. You can't. Lawyers get away with it because you're a lawyer. You can. But like, if you're an accountant or a finance person or, a person in the medical space, let's say you're a therapist, how do you as a therapist go after your clients? I don't know, man. But those are things that I know sort of like play out a lot, right? But let me ask another very important question. So if I know my cash conversion cycle, I know that it's good. I know like some of the things I shouldn't do, which is like take a lot of money out of the business as a founder, right? Or operate without a budget, which are some of the things we've spoken about, As a business owner, what do you think I should prioritize? Prioritizing means both of them are important, but like, I want to rank one after the other. Should I prioritize liquidity over profits, or profits over liquidity? What would you recommend, to a founder out here?
Wow, that's a good question, right? So this is how I would think about it, right? Like, I think the most important thing when you're running a business is, for everything that I sell, right? If it's a product, if it's a service, am I making money on each thing that I sell, right? Also known as gross margin, right? So whatever business you're doing, you need to be having a positive margin. You need to be making money off, like the cost to make it has to be lower than the cost you sell it, right? Once that's positive, below that line, it's a question of, are you trying to expand your business? So you're paying a lot of money in expansion costs, right? So you're trying to scale, right? So there are a lot of like investment in fixed in costs that aren't related to the sale, like sales team, marketing team, right? Like that you start to incur because you want to expand, right? So your profits sort of suffer a little bit, right? Like, because you make money on the sale, but because your business is in the time when it's trying to expand, you're probably burning money to scale, right? But the fundamental principle is the same. Are you making money on the product you're selling? Once you're able to answer that question, then you can answer whether is something that I should be aiming for, right? Because that answer will change based on whether you're scaling or you're not scaling. If you're scaling, I wouldn't care much about profitability, right? The thing I'm selling has a positive margin. There's sort of like an investment in infrastructure that needs to happen for me to reach this this objective. So profitability not so important, right? When you have scaled and you're a big company, right? Profitability matters, right? You have a fixed cost infrastructure, it's sunk, right? Are you profitable or not, right? So profitability matters. So then when you change the lens to simply liquidity, right? You almost take out trying to see. I think they're both important, right? Because you need to see the view of liquidity so that you know that you're able to make payments, right? But liquidity is not a driver of scaling strategy or product strategy, right? Am I making money on the product? Am I scaling? Am I not scaling? Is more for a profitability question. But to run the business, I need to know, do I actually have money or not, right?
Mm-hmm.
Regardless of what's happening on the profitability and unit economic side, if I don't have the money, there's no money, right? The business stops.
Yeah.
That's why you actually have to look at them both at the same time. I don't know if that makes sense.
So you're saying that they're as equally important, and no one necessarily trumps the other, right?
Yes, definitely. Because the strategy side requires you to understand your unit economics. It requires you to understand like how you're depreciating your assets. You bought assets, now you have to like depreciate them, which is basically like over a period of time. I need to know how my assets deteriorate. Those are factored into profitability, important for strategy. Mm-hmm. But that's not divorced from the fact that I need to know whether next month I'll make payroll. Mm-hmm. So you need to have both views. Both are important.
Okay, I'm just going to throw in a poll here and just hear what people think. So I'm throwing in a poll. Which do you think is more important? Let's see what our guests think. Cash, liquidity, which is liquidity, or profitability. Let me throw a poll in there. See what you guys think. Let me put that out there, save. So yeah, I'm publishing a poll now. I would like to see what you guys think. It should pop up on your screen. Pick which one you think works for you the most. But from my experience being an entrepreneur for a very long time, even when I was doing my 9 to 5, I still had my business running on the side. it's well beyond 10 years. One of the things that I've kind of like really, come to understand is just, the importance of cash, bro. No matter how good your business looks, no matter what your business potentially can do, no matter what I've seen businesses that are not profitable, like the Uber, really, outlive and outlast even businesses that are like really profitable because they have access to liquidity, right? And one of the things that I've learned, and I would admit, it's okay to be vulnerable out here, is that I'd rather start a business and build out, 10 potential sources of short-term, long-term capital. Short-term meaning that if I run out of cash, is there like an overdraft facility I can use? Is there a credit card I can get for my business that allows me just take care of those shortages and those periods, and doesn't stress the business, because lack of cash will stress. If you owe salaries past a month, you get into 2 months, they're going to be looking at you. By the third month, it's a problem, right? So for me, I'd advise every, SME or founder, always have short-term, long-term cash options. Build good relationships with your bank. Make sure you have people in finance that are your friends. And if you have a rich uncle, don't fight with your rich uncle. Be best friends with your rich uncle. If you have a senior sister or something that has money, maybe she's doing 9 to 5, she's oil and gas, please make her your best friend. We have to be very intentional about these things, because I can assure you will need them at some point, right? So for me, I would say cash triumphs everything. If you have cash, you can run a horrible business and just somehow, make it work. Just somehow figure a way to make it work. If you don't have cash, you would literally be like that professor that will come in looking very tattered and trying to sell himself, and they'll probably nickname you Professor John Bosco or some funny name, So for me, I would say liquidity is not just something you can tamper with. And I would personally, and this is my personal point of view, always say, hey, profit is important, because when you talk to investors and all that, they want to see you have good margins. It makes sense. So in fact, the next webinar we have is going to be on business model engineering, just how you can engineer your profit as a business, right? And we're bringing in a guest from Amsterdam. He's Dutch, and his expertise is on business model optimization and engineering. So profits are important. I'm not taking that away, but I think money makes the world go round.
No, it's I have to concede. I think if you were to rank them, I think cash is one. But I would put maybe not profitability, but unit economics second. Right?
Yes, second, yeah.
Because regardless of whether you're making cash or not, right? I guess cash will tell you also if you're making money on a unit economics. Because there's no way for you to be losing margin on a product and making cash.
Yep.
So cash is number one. Yeah, I agree.
God bless you. Because as an entrepreneur, if you don't have cash, at some point you're going to become like a motivational speaker. You're probably going to be trying to motivate everybody around you, and it's just too much work. Because like he's going to be like, who is motivating me to motivate people? You motivate your team, you motivate your family. You motivate. You start to sound like So for me, I don't. Yeah,
but I think also one thing I would also advise people, right? Because I think with tracking cash, whether you're an accountant or not, you should be able to track inflow outflow, right? You don't need an accountant for that. You should be able to do that, right? But don't take too long to formalize your finance function, right? Bringing in a Kai finance, a previous COBA accounting to formalize your finance function, right? Because to give you an example. One of my clients was a tech company doing retail, like like a platform to sell retail stuff, right? E-commerce, right? So when I was in corporate, I used to work for a company called Pepco, right? It was one of the biggest retail companies in Africa. I think it was doing like 5 billion in revenue, right? And the only thing the executive in the division I was in, he would come in and just look at margins, right, across products and be like, where are we making margin? Where are we not making margin? Why are we struggling with margin there? Like just margin, right? So I go into the startup, my friend who brought me in to help him. Then it's like, Jonathan, we're losing. This was at the height of VC fundraising. They raised $3 million, right? They were burning cash, right, for revenue, right? Then I was like, what are the margins on your product? No one could answer, right? Because there's the element of like, you're like, we're a startup, we're growing, so we don't need to formalize our finance. Bring in the Kai finance team, right? Bring them in, formalize it so that you can start tracking things that matter. Because in your mind, you think revenue, because we're a VC company, is the most important thing.
Yeah.
But then you just burn all the money, right? Because you're not making margin.
And I mean, just to add to that, I mean, I've seen working with a lot of SMEs just really teaches you things. And for me, it may be a truth or a mirror on the wall, sort of moment when you start to really look at your bank account. So I have a theory, and it's personal. I know I crack jokes a lot and say these things, but I feel like they're really life-changing things. I have a theory that for me, the book of life, when that mirrors your entire life, is your bank account, right? Like I feel like as an individual, your bank account, you can go out there and say whatever you want to say and look however you want to look. Your account balance is like your truth, is like the truth pill, or is like your truth